Introduction to Personal Money Management. Are you tired of living paycheck to paycheck and feeling like you're not getting ahead? Imagine being able to save for your dream vacation, buy that new gadget, or handle unexpected expenses with ease. Mastering personal money management is the key to achieving financial freedom. By understanding budgeting, tracking expenses, and making informed financial decisions, you can take control of your financial future. Why personal money management matters. Effective money management helps you reduce financial stress by understanding your income and expenses. Build an emergency fund to cover unexpected expenses without debt. Save for goals like vacations, education, or retirement. Make financial decisions that align with your values and priorities. Without good money management, it's easy to fall into traps like overspending and accumulating debt. Learning and applying personal finance principles can help you avoid these pitfalls and create a secure financial future. The importance of personal budgeting is fundamental to personal money management. It helps you plan how to spend your money each month and ensures you live within your means. Key benefits include 1. Awareness of spending habits. Tracking expenses helps identify areas of overspending. 2. Control over finances. Allocate income to categories like housing and savings, ensuring you prioritize spending. 3. Reduction of financial stress. A budget provides security and confidence in managing finances. 4. Achievement of financial goals. Allocate money to specific goals each month to make steady progress. Steps to create a personal budget. 1. Calculate your income. Determine your total monthly income, including salary and any side income. 2. List your expenses. Write down all monthly expenses, both fixed, rent, utilities, and variable, groceries, dining out. 3. Categorize your expenses. Organize expenses into categories like housing, transportation, and savings. 4. Set spending limits. Establish realistic limits for each category based on your income and goals. 5. Track your spending. Monitor expenses throughout the month using apps, spreadsheets, or a notebook. 6. Adjust as needed. Review and adjust your budget monthly to stay on track. How to track expenses effectively. 1. Use a budgeting app. Apps like Mint or YNAB can track and categorize spending automatically. 2. Save receipts. Record them daily or weekly to keep track of expenses. 3. Review bank statements. Regularly check statements to identify missed transactions or errors. 4. Set alerts. Use alerts to notify you when you approach spending limits. 5. Use cash for discretionary spending. Withdraw a set amount for discretionary expenses to control spending. Making informed financial decisions. 1. Set clear financial goals. Define short and long-term goals to guide decisions. 2. Educate yourself. Learn about personal finance through books, podcasts, and reputable websites. 3. Avoid impulse purchases. Consider if a purchase aligns with your goals before buying. 4. Compare prices. Always compare prices for significant expenses to get the best value. 5. Consider opportunity cost. Every financial decision has an opportunity cost, which is the value of the next best alternative you give up. When deciding how to spend your money, consider what else you could do with it and choose the option that provides the most value. 6. Plan for the future. Always think about the future when making financial decisions. This includes saving for retirement, building an emergency fund, and planning for major life events such as buying a home or starting a family. Building an emergency fund. One of the most critical components of personal money management is building an emergency fund. An emergency fund is a savings account specifically set aside to cover unexpected expenses, such as medical bills, car repairs, or job loss. Here's how to build and maintain an emergency fund. 1. Set a target amount. Aim to save at least 3 to 6 months' worth of living expenses. This provides a financial cushion that can help you weather unexpected financial storms. 2. Start small. If saving 3 to 6 months of expenses seems daunting, start with a smaller goal. Aim to save $500 or $1,000 initially and gradually increase your savings over time. 3. Automate your savings. Set up automatic transfers from your checking account to your emergency fund savings account. Automating your savings ensures that you consistently contribute to your emergency fund without having to think about it. 4. Keep it accessible. Your emergency fund should be easily accessible, but not too easily accessible. A high-yield savings account is a good option because it offers liquidity and earns interest on your savings. 5. Use it only for emergencies. Resist the temptation to dip into your emergency fund for non-emergencies. Use it only for true emergencies to ensure that the funds are available when you need them most. The role of credit and debt management. Credit can be a useful financial tool when used responsibly, but it can also lead to significant financial problems if mismanaged. Here are some tips for managing credit and debt effectively. 1. Understand your credit score. Your credit score is a numerical representation of your creditworthiness. It affects your ability to get loans, credit cards, and even rental applications. Regularly, check your credit score and understand the factors that influence it. 2. Use credit responsibly. Only use credit for necessary purchases and ensure that you can pay off your balance in full each month. Avoid carrying a balance on your credit cards, as high interest rates can quickly lead to significant debt. 3. Pay more than the minimum. If you have existing credit card debt, aim to pay more than the minimum payment each month. This reduces your principal balance faster and minimizes the interest you pay over time. 4. Consolidate debt. If you have multiple high-interest debts, consider consolidating them into a single loan with a lower interest rate. Debt consolidation can simplify your payments and reduce your overall interest costs. 5. Avoid unnecessary debt. Before taking on new debt, carefully consider whether it's necessary and how it will impact your financial situation. Avoid taking on debt for non-essential purchases. 6. Seek professional help. If you're struggling with debt, don't hesitate to seek professional help. Credit counseling agencies can provide guidance and assistance in creating a debt repayment plan. Investing for the future. 1. Start early. The earlier you start investing, the more time your money has to grow. Thanks to the power of compound interest, even small contributions can grow significantly over time. 2. Diversify your investments. Diversification involves spreading your investments across different asset classes, stocks, bonds, real estate, etc. To reduce risk. A diversified portfolio can help protect your investments from market volatility. 3. Invest consistently. Regularly investing a fixed amount of money, regardless of market conditions, can help smooth out the effects of market volatility. This strategy, known as dollar cost averaging, ensures that you buy more shares when prices are low and fewer shares when prices are high. 4. Understand your risk. Tolerance. Every investment carries some level of risk. Understanding your risk tolerance, how much risk you're willing to take with your investments, can help you choose investments that align with your financial goals and comfort level. 5. Focus on long-term goals. Investing should be aligned with your long-term financial goals, such as retirement, buying a home, or funding your children's education. Avoid making impulsive decisions based on short-term market fluctuations. 6. Educate yourself. Investing can be complex, but taking the time to educate yourself can pay off significantly. Books, online courses, and financial news are good resources to learn about investing strategies, market trends, and financial planning. 7. Consider professional advice. If you're unsure about how to start investing or need help with your investment strategy, consider seeking advice from a financial advisor. A professional can provide personalized guidance based on your financial situation and goals. Mastering personal money management is a critical step towards achieving financial freedom and security. By understanding and applying the basics of budgeting, tracking your expenses, making informed financial decisions, building an emergency fund, managing credit and debt, and investing for the future, you can take control of your financial destiny. Remember, the journey to financial stability doesn't happen overnight. It requires discipline, patience, and continuous learning. Start with small, manageable steps and gradually build on your progress. The more proactive you are about managing your money, the more empowered you will feel to achieve your financial goals and live the life you envision. If you found this guide helpful, share it with others who might benefit from it. And don't forget to subscribe to our channel for more tips and advice on personal finance and money management. Together, we can build a financially literate community and help each other succeed.